Today, we curated, reviewed and money-highlighted Jim Simons' bio video, How a Mathematician Became the Greatest Trader of All Time by Newsthink. Dive into the remarkable story, the unparalleled investor who leveraged his coding skills to achieve unparalleled success. From academia to Wall Street, Simons revolutionized trading, creating the iconic Medallion hedge fund. His coding prowess transformed finance, making him not only a master of markets but also a philanthropist shaping the universe's exploration, particularly in autism research.
When it comes to investing, nobody holds a candle to Jim Simons. Not Warren Buffett, not Stephen Cohen, not George Soros. Simons' company, Renaissance Technologies, has a signature hedge fund called Medallion that has generated average annual returns of 66% for 30 years. To put this another way, renowned economist Bradford Cornell points out that if you had invested $100 in Medallion in 1988, 30 years later, that would have turned into $398.7 million. What's even more remarkable is that Simons hired people who didn't know a thing about investing.
Is it true that you never hired people from the investment industry?
Never.
He hired mathematicians and scientists just like himself. While traditional investors rely on intuition to make trades, chatting with executives, analyzing earnings reports, gleaning insights from articles, and considering geopolitical events, Simons walked a different path. As a trained mathematician, he believed markets moved in logical ways. So he took a scientific approach to investing, harnessing the power of vast data sets, computer models, and algorithms to make decisions, inspiring a revolution that has swept Wall Street. This is the story of how a mathematician became the greatest trader who ever lived.
Jim Simons, the mind behind Renaissance Technologies and the Medallion hedge fund, stands as an unparalleled figure in investing. With a staggering 66% average annual return over 30 years, Simons' strategic brilliance is underscored by economist Bradford Cornell, who notes the potential transformation of a $100 investment into $398.7 million. What truly distinguishes Simons is his unconventional hiring approach, opting for mathematicians and scientists over traditional finance experts. This bold move, coupled with his logical approach to market movements and the use of data-driven strategies, has revolutionized Wall Street. In essence, Simons' story is a testament to the extraordinary success that stems from a unique blend of logic, innovation, and unconventional thinking in the world of finance.
Jim Simons is always restless. Building a storied career as a brilliant mathematician wasn't enough. Neither was teaching at MIT and Harvard. Neither was working as a Cold War codebreaker. He left Harvard to join an elite research organization that helped America's most secretive intelligence agency, the NSA, decode Soviet messages during the Cold War. But the work didn't satisfy him. As his first wife Barbara recalled in Gregory Zuckerman's book, The Man Who Solved the Market, Jim understood at an early age that money is power. Growing up an only child in Brookline, Massachusetts, near Boston, his family doctor encouraged him to consider a career in medicine, remarking, "You're a bright Jewish boy, you should be a doctor." But when Simons shared his passion for mathematics, the doctor replied, "Look, you can't make any money doing that stuff." Simons always wanted to be rich. When he was fired from his code-breaking job for protesting the Vietnam War, he wanted to join an investment bank. He had 3 young children to support, including a son who was born with a rare hereditary condition that affected the development of his skin, hair, sweat glands, and teeth. But he opted to stay in academia for the time being. He was offered a job to head the math department at Stony Brook University on Long Island. While it wasn't as renowned then, here he was at the age of 30 with the opportunity to shape his own mathematics department. While at Stony Brook, he developed a mathematical theory that is foundational to the work of Microsoft and other companies to create special quantum computers designed to tackle challenges beyond the reach of our current systems, including in AI.
Jim Simons' journey highlights the pursuit of passion and innovation in the face of challenges. Despite early advice to pursue medicine for financial security, he followed his love for mathematics, eventually shaping the math department at Stony Brook University. Simons' story teaches the importance of balancing passion and responsibility, showcasing how relentless ambition and innovation can lead to both personal fulfillment and financial success.
Years later, a lingering urge nudged Simons to leave academia and venture into the world of finance by starting his own investment firm. His father thought he was making a huge mistake by leaving a tenured position. Mathematicians were shocked and felt he was wasting his talent. But Simons was always unconventional, evidenced by small gestures like not wearing socks because they took too much time to put on. At the age of 40, he left his position at Stony Brook to open up a small office in a strip mall across from a train station near the university. And so began Renaissance Technologies in 1978. Back then, it was called monometrics, a play on money and econometrics, the use of statistics and math to study economic data. Just as he once unscrambled enemy code, he aimed to decode hidden patterns in the market. Simons remarked to Zuckerman in his book, "There's a pattern here. There has to be a pattern." He didn't care why the patterns existed, just that they did. Renaissance began by trading currencies, commodities, and bonds, but avoided stocks due to their complexity. There are so many of them, and each stock is influenced by the unique circumstances of its company. Simons envisioned a trading system fully guided by algorithms with no human input.
Jim Simons' shift from academia to finance with the founding of Renaissance Technologies was a bold departure, met with skepticism from his father and the math community. Simons, known for his unconventional choices like skipping socks, set up shop at 40, initiating monometrics, later known as Renaissance. His focus on decoding market patterns, regardless of their origin, led to an algorithm-driven trading approach, avoiding stock complexity. Simons' unorthodox journey highlights the power of unconventional thinking in forging new paths to success.
Let's say you want to know what the weather will be like tomorrow. You feed a computer the information you have on past rainfalls, temperatures, and humidity levels. The computer model processes the information to predict tomorrow's conditions. An algorithm then advises you on whether to carry an umbrella. Translated to the realm of quantitative finance, the weather data becomes financial data such as stock prices and trading volumes. The weather forecast becomes a market forecast, and the advice on what to wear translates to a trading decision. On the other hand, a traditional investor might try to predict the weather or the market based on subtle clues in their environment, like how much pain they're in because of their arthritis. As much as Simons dreamt of this kind of trading system, computers in the 80s were just not sophisticated enough to handle a fully automated system. So, at the start, Renaissance relied on math models and human intuition to trade, which proved problematic. His code-breaking colleague Leonard Baum, who now worked at Renaissance, liked to buy low but often clung to positions too long, like in 1984, when he heavily invested in U.S. bonds. But as the Reagan administration began issuing so many bonds, prices plummeted. Simons recognized the limits of human judgment and brought in James Axe, a friend from his PhD days at UC Berkeley whom he recruited to Stony Brook to build more sophisticated math models for trading. The team collected data from as far back as the 1800s, feeding them into computers to uncover overlooked patterns. Simons told a colleague, "If we have enough data, I know we can make predictions." Simons and Axe launched a new hedge fund, Medallion, in honor of the prestigious math awards they'd received. Medallion would eventually become the most successful hedge fund of all time. But at first, it struggled to make a profit. It didn't help that Axe isolated himself in his seaside estate in Malibu. His preference for the West Coast led him to spearhead his new company Axcom, a separate entity yet closely connected to Renaissance. The turning point came when Elwyn Berlekamp, who had worked to crack codes with Simons, bought up Axe's part of the business. He rebuilt the system to focus on short-term trades, which Axe had resisted due to concerns over commission fees. Berlekamp figured, if you trade a lot, you only need to be right 51% of the time. Many investors prefer long-term trades, a sentiment Zuckerman describes in his book this way: like fishermen ignoring the guppies in their nets, hoping for a bigger catch. Unlike these investors, Medallion honed in on these guppies, seeking to capitalize on subtle inefficiencies that others overlooked.
Jim Simons' quantitative finance approach is akin to predicting the weather. Instead of relying on subtle cues like pain from arthritis, he processed financial data like stock prices through computer models. Initially, Renaissance used both math models and human intuition, but Simons recognized the limits of human judgment. Bringing in James Axe, they developed sophisticated models, launching Medallion as a groundbreaking hedge fund. Overcoming early struggles, the fund's success was solidified when Elwyn Berlekamp reshaped it for short-term trades, capitalizing on overlooked market inefficiencies. Medallion's focus on subtle opportunities set it apart from investors hoping for a bigger catch with long-term trades.
Don't give up easily. Stick with it. Stick with it. Not forever, but really give it a chance to get where you're going. And the final principle is hope for good luck.
After a decade of adjusting their algorithms, aided by improved computer processing power, Renaissance turned the corner in 1990. The Medallion Fund posted gains after fees of 58%. But Simons believed they could do even better. He wanted 80% returns. Berlekamp thought he was crazy, and it all became too much for him. He returned to teaching at UC Berkeley. Simons bought Berlekamp's share of the company, and Axcom, which had been a separate entity, disbanded. Going forward, it was just Renaissance Technologies. Simons beefed up the team some more. Henry Laufer, a mathematician from Stony Brook, divided the trading day into 5-minute intervals instead of hourly, allowing Renaissance to quickly detect and act on even shorter-term price changes. Their models were so successful at making trades that they trusted their computers to make decisions that didn't even make sense to them. There was, however, one issue. Renaissance was still very small. It only managed $45 million after 10 years in the business, a quarter of the assets of rival firm D.E. Shaw. David Shaw was also using computer models to trade, and he was trading stocks, unlike Renaissance. Simons knew if he truly wanted to leave a legacy, he had to start trading stocks.
Persevere and give your efforts a real chance. Embrace good luck. Renaissance faced challenges but thrived, achieving 58% gains in 1990. Simons aimed higher, buying out a partner and consolidating Renaissance. With talent like Laufer, they refined algorithms for shorter-term gains. Despite success, Simons recognized the need to evolve and entered stock trading to leave a lasting legacy.
To master the art of trading stocks, he needed more help. Simons recruited Robert Mercer and Peter Brown, renowned for their groundbreaking work in transcribing speech into text at IBM. They saw language as a probabilistic game where some words likely follow others. For instance, after chocolate, milk is more probable than cheese. Similarly, Simons wanted to design a system that could predict financial market trends. With their coding chops, Brown and Mercer crafted a single automated stock trading system introduced in 1995, complete with 500,000 lines of code, compared to tens of thousands in the old system. After Mercer and Brown mastered stocks, the Medallion Fund took off. In 2000, it achieved a return after fees of 98.5%. Even amidst the dot-com bubble, showcasing Renaissance's prowess in capitalizing on inefficiencies. Simons rewarded his staff with exotic vacations and bonuses. These computer science nerds who were in it for the challenge, not the money, couldn't help but reap the financial rewards. Staff could personally invest in Medallion. In fact, as Medallion grew, it closed its doors to outside investors in 2003 and is only available to employees. The fund is capped at $10 billion. They bought so many mansions in one neighborhood that it earned the nickname Renaissance Riviera. How exactly Renaissance has managed to achieve these stunning results is a secret. Employees are bound by non-disclosure agreements, ensuring they remain silent about the coding and algorithms Renaissance uses. Many firms on Wall Street are trying to crack the Renaissance code. JP Morgan Chase makes it mandatory for new investment bankers and managers to learn coding. With advancements in technology and AI, more datasets can be collected and analyzed, even scrutinizing the tone of voice executives use on conference calls, monitoring which aisle shoppers spend most of their time in grocery stores, or analyzing the social media posts to gauge sentiment. By the way, let's connect on X. I'm at Newsthink.
To master stock trading, Simons enlisted experts like Mercer and Brown. Their language probability approach inspired a groundbreaking automated stock trading system in 1995. With 500,000 lines of code, it propelled Medallion to a remarkable 98.5% return in 2000, even during the dot-com bubble. Renaissance's success led to staff rewards and exclusive access to Medallion, capped at $10 billion. The firm's secretive methods, protected by non-disclosure agreements, fuel Wall Street's curiosity and emphasize the evolving role of technology and AI in financial analysis.
Medallion is the most successful hedge fund of all time. The returns are so high that it charges a performance fee of 44%. Simons had achieved everything he wanted to achieve in the world of investing. Simons launched a larger fund, the Renaissance Institutional Equities Fund, which is available to outside investors. REIF weathered the storm of the 2007 subprime mortgage crisis, triggered by high-risk loans given to Americans with questionable credit. In an unusual move owing to extraordinary circumstances, Simons felt the need for human intervention, guiding his team to reduce equity positions and build cash reserves. Ultimately, Renaissance rebounded, and during the turmoil of 2008, Medallion boasted 82% in profits, highlighting the sophistication and adaptability of their trading systems. Having achieved all that he wanted in the world of investing, Simons stepped down as CEO of Renaissance Technologies in 2009, handing over the reins to Brown and Mercer. Throughout his career, Simons maintained a low public profile compared to some of his peers. Simons, with a personal net worth of $27 billion, he can afford to indulge in luxuries like a $100 million super yacht. Yet his wealth doesn't just fund lavish pursuits. He's donated $500 million to Stony Brook University, established a nonprofit that provides exceptional math teachers with additional support, and started a charitable foundation that, among other pursuits, is dedicated to autism research, a cause close to his heart as his daughter Audrey, with his second wife, is autistic. The Simons Foundation is also heavily focused on discovering the origins of the universe. Its observatory under construction in Chile's Atacama Desert will search for gravitational waves from the Big Bang, hoping to unravel the mysteries of the universe's first moments. Perhaps history will not remember Simons solely for being a master of markets, but as the master of the universe. Jim Simons would never have become the greatest trader of all time had it not been for his background in mathematics.
Jim Simons, the architect of Medallion, the most successful hedge fund, achieved remarkable success with a 44% performance fee. Contemplating retirement after fulfilling his investing goals, he launched the Renaissance Institutional Equities Fund, RIEF, for external investors, proving resilient during the 2007 subprime crisis. Simons, with a net worth of $27 billion, stepped down as CEO in 2009, contributing to philanthropy, autism research, and the quest to understand the universe's origins. Jim Simons' journey from a brilliant mathematician to the mastermind behind Medallion, the most successful hedge fund, is a testament to the power of data, algorithms, and perseverance. His impact extends beyond financial markets, reaching philanthropy, autism research, and the exploration of the universe's origins. Simons' legacy reflects a unique fusion of mathematical brilliance, financial acumen, and a commitment to making a meaningful difference in the world. If you were inspired and gained insightful knowledge from our informative review, please give us a like and consider subscribe to our channel Money Highlighted for more. Thanks to Newsthink.